Hi everyone, welcome to today's webinar. Before we begin, we want to cover a few housekeeping items. To the right of your screen, there are multiple application engagement tools that you can use throughout the presentation. If you have any questions during the webinar, you can submit them through the Q&A engagement tool. When submitting a question, please note that you do have the option to stay anonymous. Underneath the Q&A application is the polling tab. Here, polling questions will be launched and you will submit your answer until the polling question closes. If the polling tab is collapsed, a banner followed by a red dot will appear to notify you that a polling question has been launched. Today's webinar offers 1 CPE credit. To obtain the full amount of credit, you must answer 3 polling questions throughout the session. Qualified attendees will receive their CPE credit in 4 to 5 weeks. To find additional session documents, click Details at the bottom of your screen. Then click View Full Session Details. Here you can find session-related content to download such as PowerPoint slides, relevant documents, and more. As a reminder, this presentation is being recorded for replay purposes. This recording can be found in the Attendee Hub and will be available as an on-demand video an hour after the webinar has concluded. Lastly, don't forget to take our post-event survey. This can be found at the homepage of the Attendee Hub. Now, let's pass it over to today's speakers.
Hello everyone, and welcome to our webinar today, in which we are going to discuss some of the credits available for EV buyers, as well as incentives for installation of your EV chargers. My name is Mike Motter, and I lead Baker Tilly's dealership practice. Baker Tilly is one of the top 10 public accounting firms in the United States. We have vast resources to call upon, and one of our specialties is in the retail automotive dealership space. We serve more than 600 dealerships across the country with tax, financial, and operational expertise. If you are not familiar with us, you can gain more knowledge by going to our website at www.bakertilly.com. Today's webinar is going to take the place of our regular Up to Speed segment. If you haven't seen our Up to Speed videos, they come out the third Wednesday of every month and are short 10 to 20 minute videos that discuss current topics within the automotive industry, ranging from tax and accounting topics to operational topics such as parts warranty reimbursement, FTC safeguard standards, Form 8300, and more. You can access and sign up for these videos on our website at bakertilly.com/dealerships. Today's topic is front and center on every dealership's agenda, and it can be pretty confusing. So we thought we would dedicate a full webinar to discuss today's topic, how dealerships can maximize the Inflation Reduction credits. As you can see from the agenda, there will be a question portion of the webinar at the end. You will also have an opportunity to ask questions in the chat box, and we will try to answer the questions live. But if we are unable to answer your question live, we will be sending out FAQ to all attendees after the webinar with the answers to the questions. Today's agenda will consist of discussions around the various tax credits either extended or created by the Inflation Reduction Act as they pertain to retail automotive dealerships. The various tax credits we'll be discussing are the vehicle tax credits, of which there are 2, Section 30D, which is the clean vehicle credit, which primarily relates to consumers, and Section 45W, which is the qualified commercial clean vehicle credit, which relates to businesses. We'll also discuss Section 30C, which is related to facility and infrastructure credits and the electric charging stations, and touch on Section 48 investment tax credits, which are going to be your alternative energy sources such as solar panels. And then we'll also talk about the ability to transfer some of these credits. So before we get started into the content of our webinar, let's take our first polling question. As you complete your polling question, I'd like to introduce our speakers for today's event. With me today are Chad Reisner and Bob Hofacker. Chad is a director with Baker Tilly in our statutory credits practice, and Bob is a senior tax manager and is one of our tax leaders on renewable energy incentives. Thank you both for taking the time today to speak with our friends in the auto industry and sharing your knowledge. Chad, let's get started with you. Can you give us a definition of what is meant by a credit versus a deduction, and what are the qualifications for the clean vehicle credits?
Thank you. Okay, so a credit is going to be more beneficial than a deduction. credit is an offset to a tax liability. So in calculating the taxable income, you have your income and you have your deductions. The deductions reduces your taxable income. Your taxable income is multiplied by the effective tax rate to get your tax. A credit reduces the tax, the amount you actually owe to the government. That is why a credit is more beneficial. Any general rule with credits are if they're not used in the current year, there is a carryback period and there is a carry forward year period. So certain of the credits, some of which we will be talking about today, can be carried back 3 years and carried forward 20 years. If they do not fall into this category, it's 1 year back, 20 years forward. So there still is carry forward and carry back for all credits. We will also be talking about some of the things that were added with the Inflation Reduction Act for credits, and that is transferability and direct pay. Transferability we'll talk about at the end, and that's just the ability to sell credits. Direct pay, certain tax exempt government entities, etc., are able to treat the credits as a payment against tax, file a tax return, and get a refund. Okay. So Section 30D. So this first credit is for new clean vehicles. So cars sold by a dealer that qualify as electric cars, new clean vehicles, are going to be eligible for the credit. This credit is not new. It has been around for a while. It was changed with the Inflation Reduction Act, or the IRA. The term used for the prior to 2023 was a new qualified plug-in electric drive motor vehicle. After, it's a new clean vehicle. So down below on the bottom half of the slide here, under new clean vehicle is basically a summary of the definition. So what is a new clean vehicle? And a new clean vehicle, again, is what is eligible to the buyer for a credit. And we'll talk about the amount of the credit and some other things about that. So the original use, so only the original user of the clean vehicle, the first purchaser who places the vehicle in service, is the one allowed to get the credit. So then it goes to, you have to acquire for use or lease, not for resale. Inventory, you're not eligible for a credit. Made by a qualified manufacturer. Manufacturer is defined in Environmental Protection Agency regulations. That's what you think of, the manufacturer of the vehicle. Qualified is what they added recently to the law, and a qualified manufacturer is any manufacturer who has registered with the Internal Revenue Service and has agreed to provide certain information to the IRS. There is a IRS website, and it lists, and every manufacturer that you would think would be registered is already registered. They're already a qualified manufacturer, and it lists all of them. So you can double check if you wanted to, but it's the ones you would think. It's all of the main manufacturers. It must be treated as a motor vehicle. There's a weight limit. They're propelled by an electric motor. So key thing here is it's got to be an electric car. Got to have a certain size battery. 7 kilowatts or more has to be the capacity. And that's under the new rules. The old rules were different. But it also has to be capable of being recharged from an external source. Final assembly occurs within North America, and the seller, you the dealer, will have to provide a report to the taxpayer, and there will be a separate report that also summarizes the information and sends.
So Chad, there hasn't been yet a standardized form that must be provided to consumers or the government, but I know there are some manufacturers that have created their own form, such as General Motors. However, to let the dealers know that NADA is looking to have some standardized form created, and so make sure you're keeping an eye out for that from NADA. So at this time, there is no requirement to submit these forms to the government, but we're recommending that you keep a good file of all your report forms so that when the IRS sets up the mechanism to upload it to the IRS, you're ready to go.
Okay, thank you. So the report. So again, there are two reports. There's one that the dealer has to give to the buyer of the car, and then there's a separate report that will be submitted to the IRS. I would imagine the one going to the IRS is going to be a summary. It won't just be a stack of all the individual reports. But When you give to the purchaser of the car, you're going to have their name and taxpayer identification number. And mainly that's because that's going to have to go to the report you give to the IRS. The vehicle identification number, the VIN number, is going to have to be on there. And a lot of this, so if you think about this, it's in theory, there's this database that's being generated and created by the IRS. Information comes from the manufacturer, information comes from the dealer. Which cars are eligible, the amount of the credit, and who gets the credit. It's all basically designed to be tracked by the VIN. So that's why you're going to see the VIN on all these reports. And that's going to track which car is eligible, who bought it, who's eligible for credit, et cetera. And it's going to work through that way. The battery capacity of the vehicle. So you got to be of a certain capacity. Again, only the original user can claim the credit. So there will have to be verification that this is a new car. It has not been placed in service for any purpose. We didn't hold it out for lease in the leasing inventory or anything like that. This is a new car. It's eligible for the credit. That will have to be stated on the report. And the dealer will also have to put on there what is the maximum amount of credit that the buyer is eligible for. And we'll talk about what the credit actually is here in a little bit. After this year, so not for this year, 2023, but starting in 2024, there is going to be a program where the dealer can purchase the credit from the buyer of the car. It has to be dollar for dollar. There can't be a discount on that. You're going to have to give them full value for that. You do not have to actually write a check and give them money. It can be an adjustment to the purchase price of the car. So whatever you sold the car for, you can knock the purchase price down. Then there will be a system set up. There will basically be a system with the IRS set up where the dealer will submit the information, the credit that you gave to the buyer. You reduce the price or whatever. You'll submit that and you'll get payment from the government for that. It is only auto dealers that can purchase the credit. So no one else can purchase these credits. Okay, so the amount of the credit. One of the things in the new law is there are rules around the battery in the car. So there are requirements on the critical minerals, the minerals used in the battery, and the components used in the battery. The new law focuses just on the battery. There's a mineral requirement and a component requirement. If you satisfy those, you get the full possible amount of the credit. Under the old law, it does not look at the battery or the components or minerals in the battery. The way the law used to work is there was a base credit of $2,500, and then it was $417 additional for every kilowatt hour of battery capacity above 5. So if it was 6, you got another $417, et cetera. It kept moving up. The maximum additional was $5,000. So the maximum credit you could get under the old law was $7,500. The reason I talk about the old law is the old law here, way to calculate the credit, is still in effect. It will remain in effect until the IRS issues guidance on how to determine whether the critical mineral and the battery component requirements are satisfied.
So Chad, do you know when we can expect guidance to be forthcoming from the government on this?
The IRS has stated that March of this year is when the guidance should be forthcoming. So that is when we are expecting to see guidance. And a key thing to note here is the calculation of the credit changes once this guidance comes out. So you earn the credit based on when the vehicle is placed in service. So whenever the consumer takes possession of the car, drives it off the lot, that's when the credit is earned. You know, they may be looking to buy, guidance comes out, that changes the rules on how you calculate the credit. As soon as those rules are issued, that's when it changes. Under the new guidance, whenever that does come out, there will also still be a maximum of a $7,500 credit. Okay. Here we've got some things on, like when we say the minerals. This is the mineral requirement in the battery. And I won't go through all the details about this because really this is going to be on the manufacturers. They're going to be the ones that have to trace this, and they're going to certify, yes, the battery in this car is eligible for the mineral requirement, half of the $7,500 credit, etc. But really what they're looking for is the minerals being processed in the United States or a country with a free trade agreement. It's sort of the Buy America thought that's going into this. The percentage will go up over time. So there's sort of a phase-in period. But after 2026, 80% of the minerals are going to have to be US sourced or free trade country. The battery component, again, this is something the manufacturer is going to have to trace and let you know that it qualifies. And this is the second half of the credit. So if you get a car or the car comes from the manufacturer is going to say, we meet the mineral requirement, we meet the battery component requirement, eligible, assuming other things are satisfied for the full $7,500 credit. And this works the same way. They're looking at North America as where the parts for the battery, the components are manufactured, and the percentage is going to increase over time.
So, Chad, I just want to reiterate that those are going to be monitored by the manufacturer. Dealers really don't need to be worrying about that aspect of it.
Correct.
Okay, so is there a list of eligible vehicles out there that's going to qualify for the credit?
Great point. Yes, there is. So that site I was talking about earlier that lists the eligible manufacturers, when you go on the IRS website, there'll be a list of all the eligible manufacturers. And there's an expand button. So you can click on each eligible manufacturer, and underneath each eligible manufacturer will be a list of all the cars that they currently have. And what the manufacturer is working with the IRS. They're submitting information telling them that, yes, we qualify. Yes, we'll give you reports. We'll give you information. Here are the cars that meet the requirements for the credit. And they'll list all those cars out there. And we'll talk later about the manufacturer's suggested retail price and the impact that has on the credit. They also list what category there you fall under. So there's a lot of information, and it tells which cars qualify and which ones don't. Okay, some other things that go along with the credit. The buyer who claims the credit has to take a basis reduction. Under the old law, so prior to 2023, there was a rule that if a manufacturer had made and sold cars that people taking the credit for above 200,000, there was first a phase out and then an elimination of the credit. So certain manufacturers' cars were not eligible for the credit anymore. That's gone. There is no limit on the number of cars that any one manufacturer can make in 2023 going forward. Every car that meets all the requirements is eligible for a credit. So one of the restrictions on this credit is the modified adjusted gross income limitation. And what this does is this applies to the taxpayer. So a lot of the information that we have in these reports that are going back and forth between the manufacturer and the dealer and the IRS, they're going to track a lot of the information. There's a couple things that are only going to be in control of the taxpayer. And this is one of those things. So the taxpayer, if they make too much money, they're just not eligible to get the credit. They just can't claim it. As a dealer, you're not going to know what their adjusted gross income is. You're basically going to have to inform them that there are adjusted gross income limitations. They're listed on here based on your filing status. If you exceed it, you're just not eligible for a credit. Doesn't matter about everything else we talked about. And one question that's coming up a lot here is, what kind of impact is this going to really have on these cars? Because the clean energy cars, the electric vehicles, are more expensive. Typically, you're going to see buyers who make more money are going to be the ones who are buying these cars. So how many people that will be buying these cars are actually going to make too much money so they're not even eligible for it? I don't know the answer to that, but I know that is a question that is being bounced around that I've heard quite a bit, that people are very curious about. How effective is this credit really going to be? Because you're going to have to hit that income sweet spot for the person needing to claim the credit. Okay, another limitation. This limitation applies to the car itself. So if the manufacturer's suggested retail price of the car exceeds a certain amount, that car is not eligible for credit. And again, sort of the same question comes up with this. Electric vehicles are going to be more expensive. They cost more than gasoline cars. How many cars are now not eligible? We do sort of know this. And like I said, you can go on the IRS website and they will list the cars that are going to qualify. But obviously, there are some more expensive electric vehicles that just aren't going to qualify for the credit at all. They break the cars down into two categories: vans, sport utility vehicles, pickup trucks, and everything else. It's based on the fuel efficiency rating that the car has. So if it's under the first category, $80,000 or less MSRP, eligible for the credit. Everything else, $55,000 or less, and you're eligible for it. Just note here for the individual, they have to have a tax liability. This isn't a credit on the individual's 1040 that can carry forward. Business credit can carry forward, but the individual has to claim it in that year and has to have a tax liability. Starting in 2023, to claim the credit, the taxpayer is going to have to put the VIN on their tax return. There's going to be a spot in the form where they have to put the VIN in. Again, I think the way it's supposed to work is cars that are eligible are going to be traced through all of this reporting and the system created by the IRS. And it's all going to be traced based on the VIN. The credit is currently set to expire at the end of 2032. So it's got a long runway right now. We're looking at about 10 years, but it does expire. It doesn't go on forever. Okay. The first part, there isn't something on the top of the slide here that we're talking about that if it's sold to a tax-exempt governmental entity, I don't think that's going to be very applicable. So the bigger thing that we want to focus on here is the ability to transfer the credit to the dealer. This is going to start next year again. And this is where the buyer of the car can come in and basically sign over the credit to the dealer. The dealer will take the credit, has to give them dollar for dollar value, and you can reduce the purchase price. It can be a down payment. However you want to apply it to the purchase of the car, you can do it that way. You don't have to actually write them a check and give them the money for that credit that you're taking over for them. There is going to be an election statement and a form. Certain disclosures have to go over. You have to talk about the incentives that are available, the credit that is available, how it's being applied. So this has to be disclosed and communicated with the buyer of the car. There will be a program so that the dealers can get advance payments. So once they do that, they don't have to wait. Because the report of all the cars that you have to give the report to the consumer no later than the purchase. So when they buy the car, you have to give them their report. The report to the IRS isn't due until January 15th of the following year. There will be an advance payment program that is set up. So under this program, you don't have to wait until January 15th to get paid for credits that you give to consumers.
So Chad, what happens if a buyer comes in and they tell the dealer that they're eligible for the credit, that they've sold to the dealer, when in fact they're not eligible due to, let's say, income levels? They're over the income thresholds and they're not eligible for the credit. What's going to happen in those situations?
So if someone, basically the credit's been claimed and the person isn't eligible for the credit, the IRS isn't going to let it just go. Who they're going to go after, though, is the consumer. They're basically going to send a tax bill to the consumer and adjust their tax liability. It will not come back on the dealer. I assume you're going to have the right disclosures and get a signature signed statement or whatever. I'm not sure exactly everything that will have to be done, but there will be procedures. But the theory is if the consumer comes in and says they're eligible, they're not eligible, it's on the consumer. It's not going to be on the dealer.
Okay, that's a good thing, though. That is something that scares dealers when they have to wait for the government to charge them back something. But also, you'd mentioned that there's going to be some type of a program that the secretary is going to be putting together. And I've had discussions with NADA, and the secretary is looking to put together a program. And I don't want to scare dealers, but it's going to be somewhat similar to the cash for clunkers. If you remember that back in 2009, where the dealership's going to go into a portal, enter in the VIN, enter the buyer information, and that's going to initiate the payment of the credit to the dealer. Now they've got a whole year to get this set up, or a little less than a year now to get this set up. So hopefully they'll have it set up in a better position than what the Cash for Clunkers program was, and it'll go more seamless than what it did at that point.
Okay, polling question number 2. Are you finding this webinar informative? And I will flip forward. I believe you can still answer the polling question. Okay, so this second credit we're talking about, this is a clean energy car credit. It's another electric vehicle credit. This is for a used car. There was not previously a credit for buying a used electric vehicle. This changed with the IRA. So this is a new provision. And again, so if a qualified buyer, and that's basically defined down below, buys a car, they can get a credit. We'll talk about the amount and everything. But the qualified buyer is an individual. So this has to be an individual. This is not a company. Businesses cannot get a used credit. Purchase the vehicle for personal use. Can't be a dependent on someone else's tax return. And every 3 years, basically, they can get this used electric vehicle credit. So they can't every year claim this credit. They have to acquire what is called a previously owned clean vehicle. That it has to be a certain number of years old. The model year is 2 years earlier than the calendar year in which you're buying the car. Again, and the original use has to commence with someone else that is unrelated. Just used car. Acquired in a qualified sale. And we've got qualified sale on the next slide, but we'll go over there. There's one key point to go over with that. Under the which bullet, a lot of this is the same stuff we saw with the new vehicle. Basically, a car that qualifies as a new clean vehicle in a couple of years is going to qualify for the used clean vehicle credit. So that's the way it works. Qualified sale. The key point I wanted to make here is the first bullet there. It's got to be a sale by a dealer. Again, the IRS is trying to track this, create these reports, this database, whatever they're doing with all this. And it's just not, that would not work if you didn't have people that were willing to submit the reports or that are registered, et cetera. You just had individuals out there selling used cars and claiming credits. It just wouldn't work out. So the car has to be purchased from a dealer to get the used vehicle credit. There's a sales price limit on the car, $25,000. Now we talked about the new clean vehicle is the MSRP on the car. It's the actual sales price for the used. So what a consumer actually pays for a new car doesn't matter. It's the MSRP. What the MSRP, well, you wouldn't have the MSRP on the used car, but it's what they actually pay on the used car. That's what matters. So those are the differences between the two of them. Again, it's one time. So you get a one-time transfer. It gets to be a used car once. So the first transfer, the original user buys it, may or may not have gotten the new car credit. The used car, whoever purchases that, if they're unrelated, they can get a credit. The credit is less than the credit for the new car. Is the lesser of two numbers, $4,000 or 30% of the sales price of the vehicle. There is an income limitation for the used car vehicle also. It is lower. So based on the filing status of the individual, the list is up here. So there's less. You're phased out of the used car credit sooner than with the new car credit. Again, everything's going to be traced on the VIN. So any taxpayer claiming the used car credit is going to have to put the VIN on their tax return. There will be a program again also where the credit can be sold back to the dealer. It's going to work just like with the new car credit, just a different amount that's going to come through. Okay. Now this is the third electric car credit that we're going to talk about. So This is the commercial clean vehicle credit. So there's a couple differences here that are actually very big, but again, what is a qualified commercial clean vehicle? It is made by a qualified manufacturer. That's the same thing we've been talking about. Manufacturer registered with the IRS for use in a trade or business, not for resale, not inventory. Then some of the definitions, either under the eithers here are things we've seen. The one difference is it is not only 14,000 pounds or less vehicles, it can be above. If it's above 14,000, you have to have a 15 kilowatt battery. If it is 14,000 pounds or less, the vehicle, you're looking at a 7 kilowatt vehicle. Fuel cell motor vehicles also qualify, so it can also be there. Depreciable. So under this credit is for a car bought that's used in a trade or business or for the production of income. That's what's going to make it depreciable. It's a business car. It's not a personal car. The red bullet here, no double benefit. The way basically all these credits work is you're eligible for one. You can't claim multiple credits. So, and really the big thing here is that if you bought a new car, 30D or 45W, you're going to fall into one. You can't try and qualify for both because you can't get both. The used car credit, you can't also get if you bought the new car because you can't buy it from yourself to get the used car credit. Again, the VIN. Everything's being traced on the VIN, so you'll have to have that to be able to claim the credit. The amount of the credit. So there's a little bit of a different calculation for the credit on the 45W. It is 15% of the basis of the vehicle. However, if it is pure electric, no gasoline or diesel engine, it's 30%. And it's the lesser of, I should say, the lesser of that number that we just talked about, or the incremental cost of such vehicle. So what the incremental cost is you're comparing an electric vehicle to the exact same model of a gasoline engine vehicle. So you take the same type of vehicle, one's electric, one's not. What is the price difference between the two of those vehicles? That's what you're looking at there. The overall limitation of the credit. So you go through the calculation and you come up with the amount of the credit. If the car is under 14,000 pounds, $7,500 is the max for the credit. Other vehicles, the larger, above 14,000, it's maxed at $40,000. So with the incremental cost, there is a notice that the IRS has sent out. This can be used as a safe harbor for 2023. And what they say in there is, with the exception of compact car plug-in hybrid electric models. So some of those, the incremental cost will always be above $7,500. So you don't have to worry about the incremental cost unless you are specifically dealing with a compact car plug-in hybrid electric vehicle. Everything else, the incremental cost is above $7,500 for under 14,000 pound cars, and yeah, that's where. Go ahead. So I said earlier, a couple rules don't apply to the 45W credit. And those are the two rules that really people are asking on what is going to be the impact of these limitations on the ability to use some of these credits. That's the income limitation and the MSRP limitation. They don't apply under 45W. So the commercial clean vehicle, you are not subject to the income limitation or the MSRP limitation. That could be a big deal. So if there is a consumer, they're looking to buy a car and they make over the threshold in income, the next question probably should be is, what are you using the car for? Are you using it for business purposes or are you using it for personal purposes? If you're using it for personal purposes, yes, this income limitation definitely applies to you and can eliminate the credit for you. If business purposes, maybe you come under 45W, maybe you don't have to worry and the income limitation doesn't apply. So it may end up being a very big difference. This credit is also set right now to run until the end of 2032. The elective payment is something I talked about earlier. Certain tax-exempt governmental entities, they can be treated as making a tax payment, and they can request a refund from the government.
So Chad, as the dealerships, I think there are some places where this 45W credit can really apply. And I look at it, and one of them is in the leasing area. So if a dealership has its own leasing program or leasing company, the dealership could lease the vehicle to the consumer and get the credit. And at that point, I think they could choose to either pass the credit on to the consumer via lower lease payments or keep the credit themselves. And I think this is a great area where you have consumers that are over that 300,000 modified adjusted gross income limit that would get an opportunity to potentially get this credit through a lesser lease payment. And then also, we have an area in the dealerships that a lot of manufacturers require the dealers to have loaner vehicles. These loaner vehicles are put into service at the dealership level to be able to use the vehicle for customers that come in for service or to test drive, things like that, but primarily for using for service, that the consumer has the ability to drive a vehicle while theirs is being serviced. So do you see any issues with loaner vehicles being able to qualify for this credit on the dealer purpose? So the dealer would actually get the credit for that?
Yeah, so it depends on how the loaner vehicle is held, I think. So if the loaner vehicle is purchased, placed in service, you're depreciating that car, that is owned by the dealer can get the 45W credit. If it's still technically in inventory and not placed in service in their trade or business, then it's still just a new car, and you're still going to be under the new car rules. So it depends on how the car is held. Again, the first user is the one who gets the credit. And it can be, the 45W is used in a trade or business. So if it's part of your trade or business, you purchase it, place it in service for lease, for loan, whatever, placed in service in your trade or business, you can be eligible for a credit, yes.
Okay, so I think, that's a big thing, because in dealers, it's kind of all over the place. Some dealers leave their loaners in inventory, and some set them up on their fixed asset schedules and depreciate them. So if they are depreciating them, they get the credit. If they're not, and leaving them in loaner as an inventory item, then they do not get the credit. So good. One other thing that I was thinking about is, we've got the 25 credit, and so that's on the used vehicles. But if a consumer, I'll give you an example. If I came into the dealership and I'm under all the limitations that are required, so I qualify for the new vehicle credit. If I lease it from the dealership and they get the new vehicle credit and I negotiate, hey, I want my lease payments lower because I know you're getting that credit. So they go to that and say, hey, we'll put this as part of your down payment on the vehicle. I have the lease for 3 years, and now I buy that vehicle as a used vehicle from the dealer after the lease is gone. Do I then qualify again for the $4,000 credit? Or could I potentially?
Yes, there could, in theory, be the double benefit there, because technically the dealer would, since the dealer is leasing the car, the consumer doesn't own the car, so they don't get the new car credit. Now they may get benefits based on reduced lease cost or whatever you want to pass on to them, but whoever owns the car, the dealer, would get the credit under 45W for having the commercial vehicle. And since the lessee who has been leasing the car, if they purchase it at the end of the lease, they are purchasing from an unrelated third party, they can get the used car credit for that.
Okay, so that's actually a way to get a significantly higher credit as a consumer if you hit the right limitations. So one question that came in is, should the dealer title that loaner EV in its name to be safe? And I'm thinking the answer is going to be yes. If we're putting it into fixed assets, we probably want to put a registered plate on that vehicle.
Yeah, I guess it depends on what you want, but yes, if you're looking to claim the credit, I would say yes. Okay. Next polling question. Do you anticipate installing EV chargers in 2023? I think I can go forward. Okay. So Code Section 30C deals with a lot of alternative fuel vehicle refueling property, all kinds of different property. What is relevant and what we care about today is electric charging stations. So there is a credit for electric charging stations. And on this chart here, we have the prior law and the new law. So this law is not new again. This is like a lot of the code sections that we find in the Inflation Reduction Act. They've been around. They've been changed, some drastically, some just a little bit, but there have been changes from the Inflation Reduction Act. Not some of them are completely new, but this is a credit that has existed in the past. So anything placed in service before the current year basically was eligible for 30% of the eligible basis. That was the credit. It's pretty simple. Some of the changes, the way the new law applies compared to the old one. So the new law will go out through the end of 2032, property placed in service by that time. We start with a base credit percentage of 6% of the eligible cost of the property. So that's the base we start at. Within the Inflation Reduction Act, there is this prevailing wage and apprenticeship theory. And I don't want to get too sidetracked on that because we can go on for a very long period about that. But if the prevailing wage and apprenticeship requirements are satisfied, you get a 5 times bonus. So that 6% credit goes up to 30%. One of the big restrictions, I think that's going to hit after 2022, anything placed in service, is it must be placed in service in an applicable census tract. If it's not in a non-urban area or a new market tax credit distressed area, it is not that charging station is not eligible for a credit. We're going to talk about here at the end transferability of the credits. This is a credit that is eligible to be transferred, but I'll leave the whole discussion on transferability up until later. Okay. So again, what we talked about, the credit is a percentage of the basis of the property. We have the 5 times multiplier, so you go from 6 to 30%. And again, the biggest thing is it's got to be in an eligible census tract starting this year going forward. Okay, the basis of the property is going to be reduced by the amount of the credit. Certain rules, charging station is not really going to be an issue. It's going to be used in the U.S. Anything installed outside of the U.S. obviously won't qualify. It has to be placed in service, and it is a credit that can be sold.
Okay, so one thing is, thank you, Chad. I appreciate all your insight on this, but there are many dealers that are going to have transformers or new electrical service that are brought into their facilities in order to have enough power to run some of these superchargers that many of the manufacturers are actually requiring. So for a dealer, you may want to consider having this service only tied into their chargers and not to the overall facility. So don't have it the electrical coming in, have it running to your service bays, your lights, your interior lighting, your lot lights, things like that. When you have the new service powering only the chargers, you could get some accelerated depreciation on the installation of that service. And we're seeing some fairly high costs depending on where the utility comes in. If they've got to put in a new transformer, if they've got to run some of the electrical, the high voltage electrical running through the parking lot to get across the parking lot to the facility. So we're seeing some high costs. So on kind of a tax strategy, you want to make sure, if you can, to have any of the new installation of the utilities going only for the chargers and not servicing any of the other facilities. So at this point, let's shift gears a little and let's discuss other energy credits dealers can obtain through investments in alternative energy sources, such as solar power and wind power. So Bob, can you lead us through this discussion?
Yeah, thanks, Mike. And we haven't talked about this before, but I think it's a good point you brought up on the cost to bring in electricity. I mean, that pairs with this well. Solar opportunities, like we're going to talk about under the Section 48 credit, could be a good alternative there. So The Section 48 investment tax credit, just to give some background prior to where we were at before the Inflation Reduction Act, there was two main credits centered around renewable energy. They were the Section 45 production tax credit, which we're not going to discuss today, and then the Section 48 investment tax credit. Production tax credit, is going to be based on the amount of electricity you're actually producing, and you claim a credit over a 10-year span. The investment tax credit is going to be a one-time tax credit based on the overall cost of a project. So like Chad had mentioned before, this is an either or. Either get the Section 45 production tax credit or the Section 48 investment tax credit. Given, the dealer landscape, you're probably going to be looking at the Section 48 investment tax credit. So that's where we're going to focus. So prior to the IRA, the credit was a flat between 26 and 30%, depending on what type of energy property you were looking at. Other things under the old law, I guess the big one there is there was no transferability. If you were going to claim the credit as a dealer, you actually had to monetize that against existing tax liability. So that's kind of where the Inflation Reduction Act really opened this up. One, they allowed the transferability that we're going to talk about. And two, they also kind of changed the credit regime, how it's calculated. Now there's a straight flat 6% with a bonus structure. So Chad mentioned the 5 times multiplier. That's going to be one of them, with a few additional ones being the domestic content bonus, energy community, and then the low income community allocation there. From a timeline perspective, the new credit regime is kind of split into 2 timeframes. So the existing Section 48 that we're going to talk about, it's going to run through projects placed into or begun construction. So projects that have begun construction before the end of 2024. And then a similar credit regime, slightly changed, is going to be under 48E, is going to be for all projects placed into service after that 2024 date. And that's more of a carbon neutral tax credit, where if you're producing electricity that's carbon neutral, you're going to be eligible for that. So we'll look at how the credit's actually calculated and what energy property means. The credit calculation is based on the cost of qualifying property in a project. So we're going to refer to that as energy property. And what is energy property made of? You see the list on there: solar, geothermal heating, fiber optics. I think if we look at solar, that's probably going to be most applicable here. This could be placed on the dealer rooftops, on parking garage rooftops. And I think as Mike brought up, even on a smaller scale, I could see these being paired, a couple solar panels to each EV charging station, kind of reducing that, capital spend load to input the charging stations. I could see that happening. Also want to bring up with new builds or with renovations of existing dealerships, a lot of these other ones could come into play. The electrochromic glass, it's tinting windows, basically, adjusting the tint depending on the time of the day and the actual sun that's allowed through. So that could be one. Big thing to take away here, I think, is that, if you're doing new construction, if you're doing a revamp on a dealership, reach out to someone and really look into these clean energies and the potential incentives there. A lot of the times when we come across new projects like this, if we make a few small tweaks to the design or where your power is being brought in, there's really no incremental spend, but you're now capturing equipment costs that are going to be eligible for the 30 or 40% tax credit that we're going to discuss here. So that's big picture on the credit calculation and what's qualifying. So what are the requirements to actually claim the credit? So the credit is the credit is earned when a project is placed into service. So the key is that you actually have to own the physical asset when it's placed into service. Sometimes on these, you'll actually have a developer who wants to own the asset on a site, but from a dealer perspective, you're actually going to have to physically economically own that EV charging station or the solar on top of the rooftop. That's going to be key there. After the credit is placed in service, there's going to be a 5-year recapture period where you have to maintain ownership. So if you would sell the project or it would no longer be in use during any of that 5-year period, you would be subject to recapture and have to pay that tax credit back to the IRS. I think it's also important to note here that when the credit is claimed, there is a 50% basis reduction in the overall asset. So really that just means that, you're going to be able to take, or you're not going to be able to take as much depreciation as you would have been if you did not claim the credit beforehand. So if a solar panel, you could depreciate it, it costs $100. If you take a $50 tax credit, you have to reduce that basis by 50% of the overall credit. So now your depreciable basis is down to $75 of the total eligible cost there. And then from our perspective, when we look at these projects, how do we actually calculate the credit? It comes down to reviewing the overall project costs, including, any engineering you're done, any construction work, foundation work. We're going to look at all of that. We're going to carve out what's qualifying and what's integral to actually producing the energy. So it's a solar project to use, for example, it's going to include the foundation, the concrete that's being poured, the frame, the actual solar panels themselves. That's all going to be eligible. And then a percent of any indirect cost, engineering, time that's captured as that. And as we move forward, we talked about the base credit now. For under the new Section 48 regime, the base credit is now 6% of those qualified costs with potential bonus amounts to be added. So I think we're going to walk through some of the bonus credits here with the last 10 minutes we have here. The first bonus amount is that 5 times multiplier, very similar to what Chad was describing for the other credits. One of three ways to meet that. I think in all of the dealership projects, they're going to meet that first point there where the project maximum net output is less than 1 megawatt. So I don't think any project, I guess for the most part, would scale larger than that. If they do, that's when you're going to have to meet the prevailing wage requirements and apprenticeship requirements. And, that's a technical conversation, but I guess what it really means high level is that the contractors who are installing these projects are going to have to employ apprenticeships, and they're going to have to pay a high enough rate. And really that comes down to the spirit of the law that was passed, right? They want to incentivize renewable energy projects, but then also create high paying jobs and then support the technical trades behind those. So they want the actual tradespeople and their industries and apprenticeships to be supported throughout this. An additional bonus. So now we got the 5 times multiplier. We're at the 30% tax credit. There's an additional 10% credit if your project is, manufactured in the United States. So that's the domestic content requirement that we're going to discuss here. And really what that comes down to, there's some unknowns at this time, but generally it means 100% of the structural steel on a project is manufactured in the U.S. And then from a component perspective, at least 40% of the components have to be manufactured in the U.S. And that's the requirement for 2023. That 40% scales up to 55% over the next 3 or 4 years here. So what we're waiting on guidance for is, what is structural steel on a solar project? We're kind of talking through, it's really probably only the rebar and the concrete foundation. That might be the only structural steel on a project there. And then from the manufactured component perspective, it's really how far back in the bill of materials do you have to go to confirm domestic production? Because right now in the U.S., a lot of the solar panels, they're manufactured overseas. The U.S. doesn't have the infrastructure to support that. So individual pieces, the frame, the glass, the photovoltaic cells, they're manufactured overseas, but then assembled in the U.S. So the question is, does that assembly in the U.S. count? That's kind of what we're awaiting guidance on and expect to receive here sometime in the next 3 to 4 months. So yeah, that's the domestic content. It's a 2% credit, assuming you get the 5% multiplier. It's up to 10. So now we're looking at a potential 40% credit as we get there. And then this slide I like to show because I really think it does a good job illustrating what the potential tax credit is. So if you start at the top of the base credit, 6%, the 5 times multiplier, domestic content, the next two, energy community there and environmental justice, those are specific to the census tracts you are located in. Energy community means, any census tract that's been impacted by the coal or oil industry is typically going to be eligible for that. And then the environmental justice is for low income areas. We won't get into specifics of those, but we do have some maps internally at Baker Tilly and on the web you could probably find to look to see if your project is qualifying for those two bonuses. And then I think that last red bar on there, where you're getting your funds to fund these projects does matter. If you're using tax exempt bonds, there is an overall 15% reduction. And that 15% is a reduction of the overall calculated credit, not the percentage. So you're not going from, say, 30% if you only meet the 5 times multiple down to 15%. It's just a 15% reduction. So you'd still be left with about a 25% tax credit.
So Bob, are these credit percentages dependent on each other, or are the qualifications for each separate?
No, they're not really dependent on each other at all. I mean, you can mix and match these. I think the only thing to note is that if you don't meet the 5 times multiplier, you're only going to get the 2% for the domestic content and the 2% for the energy community. That's the only interdependency there. Otherwise, they're kind of a standalone test. So,
okay, thanks. So I also want to mention that, there are some other non-tax incentives that are available for dealers to go green, to put up solar panels and such. It's going to be based on your manufacturer, but some manufacturer programs have actually given you additional vehicle inventory allocations to the dealers if they install solar panels. Now, they have to have the inventory in order to give that to you. So I don't know how much of a benefit that is, but as inventories are starting to increase now, that might be a benefit to get additional allocations.
Yep. Yeah. And we have seen that in practice on a few times here. So we got 3 minutes left here. So the fourth and final polling question, would you like to discuss your project or other IRA considerations? I'll let you answer that. And I want to tackle this last topic here because I think it's probably the most important. The transferability of the tax credits, under section 6418, this was a new code section that was added. And it's really the game changer, right, behind the Inflation Reduction Act. It allows for taxpayers to sell their ITCs, their investment tax credits, for cash to unrelated parties. And really the only requirement behind that is the payment must be for cash. You can't exchange it for services or other tangible property. And then the key here is that the seller, they're not taxed on the proceeds they receive. So that's essentially tax exempt income to them. On the other side of that, the buyer isn't receiving a tax deduction. So kind of net neutral there. The mechanics behind transferring the credit, somewhat unknown right now, just waiting on guidance. But the ability to transfer is going to be made on your tax return, right? You're going to have to file an election to transfer the credit. You're going to report who you're transferring it to. And you have to make that election on a timely filed return. So, on a calendar year taxpayer, that's, September 15th or October 15th. But I think what's important to note here is that the credits can only be transferred once, and they have to be transferred by the entity that's placing the project in service. So in a flow-through structure, if you're passing those credits up, the individuals up top cannot transfer those credits. The actual entity claiming the credit will have to. And that goes for the buyer of the credits too. They can't resell, essentially. So last slide here. Flow-through entities are eligible to transfer the tax credits, right? Partnerships and S-corps. That tax-exempt income then that's recognized at the flow-through level has to be allocated in similar manners as what the tax credit would have been. That's pretty standard for allocating tax credits. And there are, of the credits we talked about today, 30C and Section 48 are the eligible credits for transferring for cash. So Last point here, if you're a nonprofit or a governmental entity, there is a direct pay option where you just receive an actual refund from the government. So that's what I think we had here. I'll pass it back to Mike for a question and answers if we have any.
Okay, thanks, Bob. Yeah, so we do have a couple of questions that have come up. Chad, I think some of them are going to apply to you, but so this is a situation. A dealer holds a loaner vehicle in inventory under a leasing permit with the state. The loaner is sold as a used vehicle. The customer qualifies only for the used vehicle credit. Is that a yes or a no?
If it was placed in service, yes, it is going to be a used vehicle. And again, remember though, for the used vehicle qualification, it has to be model year has to be 2 years prior than the year of the sale. So if it's only been held for a short period of time, it won't qualify for it either.
Right, and under that situation, I'm thinking, and I don't know for sure. I'm hoping you know the answer on this one, but the dealer is looking, can they actually claim the credit on that? But if they're leasing the vehicle under a leasing permit with the state, it sounds like the state might be the lessor and thus gets the credit.
Yes, if the state is the owner and the lessor, the state would be technically the one who can claim credit. And if there is a benefit if it is, I don't know, if 45W is a credit that a tax exempt or government entity can get a refund for, can get direct pay. So if it's commercial, qualifies under the commercial clean vehicle, state may be able to get money back.
Okay. Another question. So selling vehicles to tax exempt or government units. Now I know under the 45W it said that they may be able to get some of those credits, but in the dealership world, these sales are considered fleet sales to potentially a state or a city. The government has the mechanism for the claim, so the dealer doesn't get the business credit, correct?
Correct. If it's sold to a tax exempt government entity, anything, that purchaser is the one who's eligible for the credit. Yeah.
Okay. And one more question is, dealers will or will not, and I think this is related to the consumer credits, dealers will or will not receive any form of a credit for these programs because the credits are applicable to the buyer only on their personal or business tax returns. And I think the answer is yes and no. If the consumer acquires that vehicle, they get the credit. If the dealer has a leasing company and they acquire the vehicle from their dealership, put it into their leasing company, and then subsequently lease it to the consumer, then the dealer or the leasing company gets that credit.
Correct. Yep.
Okay, that is all of the questions that we have. So with that, this concludes our webinar today. If you have any questions related to the IRA energy credits that come up in the future or on anything discussed here today, please feel free to reach out to myself, Chad, or Bob, or your current Baker Tilly representative. If you'd like to add additional information or to view other topics discussed on our Up to Speed series, head over to bakertilly.com/dealerships for more information. Thank you for joining us today and make it a great day.